Amid escalating trade wars and political turbulence, investors are massively divesting from American assets. The euro is soaring triumphantly, reaching unprecedented heights against the dollar. In early April 2025, the euro's exchange rate experienced a rapid surge, climbing over 5% in just 10 days. On April 1st, the rate was recorded at 1.0807, and by April 11th it had peaked at 1.1351. This jump reflects a growing preference among investors for the European currency amid concerns about the stability of the U.S. economy. On April 2, 2025, President Donald Trump's administration imposed comprehensive tariffs of 10% on all imports into the United States, which acted as a catalyst for this currency shift. In an era of global trade, China faced severe economic measures with a 145% tariff imposed on Chinese exports to the United States. The European Union also did not escape protectionist measures, facing a 20% tariff. These steps were presented as an attempt to protect American industry and reduce the trade deficit. However, the effect was different. Significant instability arose in global markets, forcing investors to seek refuge in more reliable assets, such as the euro. The unexpected introduction of these tariffs, accompanied by contradictory statements from the administration, such as the announcement of a 90-day suspension of mutual tariffs for most countries except China, only heightened market uncertainty. Such unpredictability undermined confidence in U.S. economic policy, triggering capital outflows and weakening the dollar's position. Against this backdrop, the relative stability of the euro and the consistent policy of the European Central Bank, aimed at maintaining an adaptive monetary policy, made the European currency an attractive alternative for investors. The U.S. dollar index, DXY, which reflects the value of the dollar against a basket of major currencies, showed a significant decline, falling below 100 points for the first time since July 2023. By April 11, 2025, the U.S. dollar index, DXY, recorded 99.78, down 1.07% from the previous value of 100.87. The fall in the DXY reflects growing concern about the resilience of the American economy, driven by escalating trade disputes and political instability. President Donald Trump's recent decision to impose sweeping tariffs, including 10% on all imports and increased rates reaching 145% for Chinese goods, has triggered significant fluctuations in global markets. These protectionist measures have forced investors to reassess the safety and attractiveness of American assets, causing capital outflows and weakening the dollar. In an environment of uncertainty caused by U.S. economic policy, investors have turned to traditional safe haven currencies. The Swiss franc and the Japanese yen have strengthened against the dollar, indicating a shift in market sentiment. On April 11, 2025, the Swiss franc peaked at 175.234 against the Japanese yen, reflecting increased demand for stable currencies amid market turbulence. Economic observers are sounding the alarm. The weakening of the dollar could trigger a storm of negative consequences for the American economy. The fall in the dollar's exchange rate calls into question its role as the world's main reserve currency, which threatens to reduce global interest in American assets and increase borrowing costs for the United States. Amid the colossal U.S. budget deficit, which reached $1.8 trillion in 2024, a drop in demand for dollar-denominated securities could only add fuel to the country's financial problems. In parallel with the weakening dollar, there is an explosive rise in gold prices, which reached a historic peak of $3,223.72 per ounce on April 11, 2025. This trend serves as a clear indicator of growing investor anxiety, seeking a safe haven for their capital in a shaky economic situation. It should also be noted that President Donald Trump's aggressive tariff policy has already caused serious turmoil in U.S. financial markets, triggering a massive sell-off of both Treasury bonds and stocks. This market turbulence continues to undermine confidence in the American currency and raises well-founded concerns about future economic prospects. The traditional haven of calm in the raging sea of the economy, the U.S. Treasury bond market, has been stirred by unprecedented turbulence. After the resounding announcement of the introduction of large-scale tariffs on April 2, 2025, investors, like frightened seagulls, rushed to abandon complex structures built on borrowed funds, such as basis trades and swap spread strategies. This exodus triggered a real liquidity crisis. The massive outflow of capital from Treasury bonds caused a sharp jump in yields like a sudden tide. The yield on 10-year Treasury bonds surged from 4.2% to 4.43% in just 4 days, marking the fastest increase since the 2008 financial storm. Similarly, the 30-year bond yield experienced its steepest 3-day climb since 1982. This downturn was exacerbated by concerns that major foreign holders, primarily China and Japan, might begin to reduce their substantial holdings of U.S. debt, threatening further market destabilization. Concurrently, U.S. stock markets underwent a period of significant losses. Key indices, including the S&P 500 and Nasdaq, entered correction territory, with the S&P 500 plummeting more than 10% in just 2 days, like an avalanche sweeping away everything in its path. Financial markets are experiencing a period of turbulence marked by the most significant downturn since the COVID-19-induced collapse in 2020. The Dow Jones Industrial Average, a barometer of the American economy, recorded an unprecedented series of losses, twice tumbling more than 1,500 points in succession. This decline led to the evaporation of a colossal $6.6 trillion in market value, indicative of the profound anxiety gripping investors. The impact of economic hardship is also being felt by average consumers. According to research from the Yale School of Management, the average American family will face an additional $3,800 in annual expenses due to the increased cost of imported goods. This surge in consumer prices is projected to drive inflation up by 2.3% in 2025, further straining household budgets. In light of these developments, economic growth forecasts have been revised downward. The U.S. Federal Reserve has adjusted its GDP growth forecast for 2025 from 2.1% to 1.7%. Similar concerns are being voiced by international organizations. The OECD projects a slowdown in growth to 2.2% in 2025, with a further deceleration to 1.6% in 2026, indicating ongoing uncertainty regarding the outlook for the global economy. In 2025, amid rising tensions with the United States under President Donald Trump's administration, the European Union and Canada are taking decisive steps to intensify bilateral trade relations. New tariffs imposed by the U.S. have catalyzed the EU and Canada to seek more reliable and mutually beneficial economic partnerships. In February 2025, Canadian Prime Minister Justin Trudeau met with European Commission President Ursula von der Leyen and European Council President Antonio Costa. During the talks, the parties emphasized the need to strengthen economic ties between Canada and the EU to maintain global economic security and stability in the face of increasing geoeconomic instability. Since the provisional entry into force of the Comprehensive Economic and Trade Agreement (CETA) in 2017, trade relations between the EU and Canada have demonstrated significant growth. Between 2016 and 2022, bilateral trade in goods and services increased by 65%, with EU exports to Canada rising by 60%. These figures demonstrate the great potential for further development of economic cooperation between the two regions. Impressive growth has been demonstrated by exports from individual sectors, with pharmaceuticals increasing their shipments by 74%, agriculture by 50%, and machinery by 42%. According to statistics, in 2022, the European Union exported goods to Canada totaling approximately $49.11 billion. A significant proportion of this volume is accounted for by machinery, pharmaceuticals, vehicles, and mineral fuels. Canada, in turn, has recognized the European Union as its second-largest trading partner. Canadian exports to the EU reached $34 billion, while imports reached $84 billion in 2024. Compared to 2015, exports increased by 57% and imports by 61%, indicating a significant strengthening of trade ties. It should be noted that the Trump administration's imposition of a 25% tariff on Canadian imports, with the exception of energy, which is subject to a 10% tax, has led to a deterioration of trade relations between the U.S. and Canada. In response to these measures, Canada imposed retaliatory tariffs on $29.8 billion worth of American goods, targeting key industries such as steel, aluminum, and automobiles. These events have catalyzed Canada to seek alternative markets and strengthen existing partnerships, especially with the European Union. The European Union has also felt the challenges emanating from the trade policies of the United States. In particular, when the American side rejected a proposal to create a zero-tariff zone aimed at eliminating duties on industrial goods between the EU and the US. In response, both the European Union and Canada are actively exploring opportunities to further strengthen bilateral trade ties. One promising area is expanding cooperation in the defense sector. Canada is considering diversifying its sources of military equipment, showing interest in purchasing from European manufacturers, which would reduce dependence on American suppliers. Furthermore, the EU and Canada demonstrate a unity of views regarding the global trading system based on clear rules. Both sides are working closely to maintain multilateral trade agreements, seeing this as the key to stability and predictability in the global economy. This common position underscores their commitment to resisting protectionist tendencies and contributing to maintaining economic stability at a global level. The strengthening of the euro on currency markets is a symptom of changing investor sentiment, who are increasingly viewing European assets as a safer haven amid growing trade tensions initiated by the United States. If American policy continues to undermine confidence in the dollar, this trend could lead to a long-term rebalancing in global currency markets. The American currency is experiencing tough times, demonstrating a decline of more than 1% against key global currencies. This decline has pushed the dollar to its lowest levels in the last 3 years, exacerbating the overall downward trend, which has reached almost 10% since the beginning of the year. Despite steps taken to partially reverse previously imposed trade tariffs, including a temporary freeze in relations with China for a period of 90 days, investors continue to have serious concerns. The source of this anxiety is the unpredictability of the political course of the United States, which negatively affects the traditional role of the dollar as a reliable, safe haven asset in times of economic instability. The trade policy pursued by the Trump administration has led not only to an aggravation of the international situation but also to tangible economic losses within the country. Among the negative consequences are a slowdown in GDP growth and an increase in consumer prices, particularly for European consumers. Although the short-term impact of these measures on exports is obvious, experts note that diversifying trade strategy may help mitigate long-term risks. Analysts from the Yale Budget Lab have calculated that the average effective tariff in the United States is currently 22%. This figure is significantly higher than the 11% recorded before the introduction of new tariffs and is the highest since 1909. In turn, experts at Inflation Insight predict that the average weighted tariff rate could rise to 25 to 30%, which is significantly different from 2% in the previous year. For a deeper understanding of the current state of the global economy, it is necessary to look to the past and assess the key role that the US dollar has played for many years in shaping the global economic environment. For decades, the American currency has served as the cornerstone of the international monetary system, providing more than 85% of all global currency transactions and accounting for nearly 60% of the planet's currency reserves. However, increased geopolitical tensions, the increasingly unpredictable domestic policy of the United States, and the growing desire of various countries to diversify their economic activities are putting significant pressure on the dollar's dominant position. This process of abandoning the dollar, known as de-dollarization, has been developing gradually, but recent events have given it particular relevance. Various disruptions in world trade, chaotic U.S. decisions regarding tariffs, and growing currency volatility have forced many countries and corporations to reconsider their degree of dependence on the American currency. De-dollarization is essentially a strategic step aimed at reducing dependence on the dollar in trade operations, reserves, and financial infrastructure. At the heart of this process are various motives, from concerns related to the use of the dollar by the United States as an instrument of sanctions policy, to the global economic consequences of American monetary policy affecting international capital flows. The desire of developing countries to strengthen financial independence in the face of instability is particularly pronounced. Key players are actively involved in shaping a new financial reality. China is steadily expanding the use of the yuan, especially in the field of energy trade, while Russia is increasing the use of the ruble and yuan in settlements. Associations such as BRICS and the Eurasian Economic Union are also considering ways to reduce dependence on the dollar and create an alternative monetary system. At first glance, the weakening of the euro would seem to strengthen the dollar, but paradoxically it could accelerate the abandonment of both currencies. When both the dollar and the euro show signs of instability, states are more actively entering into bilateral trade agreements, avoiding the use of both currencies. Settlements in national currencies or in more stable regional monetary units are gaining popularity. An example is the deal between India and the UAE to trade oil for rupees, as well as Brazil's transition to settlements with China in yuan and the use of the RI settlement unit. The recent volatility of the euro has only heightened concerns about the risks associated with dominant currencies and strengthened the desire to seek alternatives. Moreover, the current situation has rekindled interest in regional currency systems. Fluctuations in the dollar and euro exchange rates are pushing associations like BRICS to accelerate the development of alternative settlement mechanisms, including proposals to create a common currency or digital assets, such as a digital analog of the euro or a UN digital token. The observed actions indicate a large-scale desire to reduce dependence on financial instruments developed by Western countries. Central banks of various states are also not standing aside from these processes. In an environment where the euro faces challenges and the use of the dollar for political purposes raises more and more questions, some financial regulators are revising the structure of their reserves. They prefer gold and other assets that are more stable and less susceptible to political pressure. The International Monetary Fund noted a 1.5% decrease in the share of the dollar in global reserves in 2024, while recording a significant increase in interest in gold and alternative currencies. Apparently, this trend will only gain momentum. In response to the ongoing changes, the European Union and the United States are revising their own strategies. The EU is actively working to strengthen trade ties with African countries and Canada and is also considering introducing a digital euro which could become a more reliable and stable reserve asset. In addition, the European Union is creating new currency swap lines with the central banks of countries outside the Western Bloc, seeking to stimulate trade in euros and strengthen confidence in the currency. While America faces growing international discontent over the use of the dollar as a lever of political pressure, the prospects for its dominance in the global financial system are under threat. Further de-dollarization, encompassing both allies and large financial institutions, could significantly weaken the position of the American currency. The recent weakening of the euro, which would seem to undermine its status as an alternative to the dollar, actually highlights the general vulnerability of any single reserve currency in the context of modern instability and multipolarity. Instead of stopping the de-dollarization process, this episode only reinforces its rationale. Instead of looking for a single replacement for the dollar, many countries are preparing for a world where financial power is distributed among various assets and agreements. Gold, digital currencies, and regional trade blocs are seen as elements of a more diversified and sustainable foundation for international trade and reserves. It is possible that the post-Bretton Woods era with its single dominant reserve currency is coming to an end. It may be replaced by a more fragmented but balanced system reflecting the new contours of global economic power. In early 2025, the political arena was once again shaken by statements from Donald Trump, this time addressed to the BRICS countries, where the desire to challenge the hegemony of the dollar was becoming increasingly clear. The ex-president, not mincing words, outlined the prospects for tough retaliatory measures. The reason for such a sharp reaction was the increasing talk about creating an alternative currency under the auspices of BRICS, as well as the growing practice of bilateral trade in national currencies. Trump, speaking to his supporters, said that the United States would not tolerate such encroachments on the position of the dollar. We will demand guarantees from these seemingly unfriendly countries that they abandon the idea of a BRICS currency and support for any other currencies seeking to replace our mighty dollar. Otherwise, they will face 100% tariffs, he proclaimed, making it clear that there would be no compromises. However, as is often the case in politics, there is a paradox behind the loud words. Trump's own trade policy, in particular the large-scale tariffs introduced under the slogan of Liberation Day, ironically only fuel the very trends he so fiercely opposes. Economic communities and international relations experts are expressing concerns that policies designed to protect America's economic interests are, in reality, undermining global confidence in the dollar and inadvertently stimulating de-dollarization processes. The currency market reacted immediately. Following the introduction of tariffs and heightened trade tensions, the U.S. dollar index experienced a drop exceeding 1% in just 1 week, marking the most significant decline in the past 3 years. Since the beginning of the year, the drop has been nearly 10%. There is an increasing outflow of capital from dollar-denominated assets as investors seek refuge in gold, the Swiss franc, and even cryptocurrencies. The reliability of the dollar as a safe haven for capital is being questioned not only by foreign governments but also by large institutional investors and central banks. In the context of global trade, the United States is increasingly perceived as an untrustworthy partner. In response to Washington's actions, China has imposed retaliatory tariffs reaching 125% on American goods. Countries such as India and Brazil have begun entering into major energy and commodity deals using their national currencies or Chinese yuan. Distrust of the U.S. currency is pushing nations to enter into currency agreements and create regional payment systems, reducing the dollar's role in international transactions. Global financial institutions are also taking note of these changes. The IMF and the World Bank are recording a slight but noticeable redistribution of global reserves. The IMF's 2025 report indicates that the dollar's share of global reserves has decreased by another 1.8%, while reserves of gold, yuan, and other alternative assets have slightly increased. Central banks, particularly in Asia and Africa, are seeking to diversify their portfolios in response to the politicization of the dollar that occurred during the Trump administration. From a macroeconomic perspective, Trump's protectionist tariffs may have also contributed to the weakening of the American economy. Increased import costs are driving inflation, while retaliatory measures from other countries are reducing demand for U.S. exports, particularly in sectors such as manufacturing and agriculture. These circumstances may prompt the Federal Reserve to adopt a looser monetary policy, which in turn would further weaken the dollar due to lower interest rates compared to other leading economies. As the United States continues to grapple with the challenges of growing national debt and budget deficits, more experts are expressing concerns about the long-term stability of the country's financial system. Voices are being raised criticizing the Trump administration's economic policies, which some consider short-sighted and risky. In particular, they note that using trade leverage as a tool for pressure and the politicization of the dollar's exchange rate could have undesirable consequences. Critics argue that such policies could push the world towards a multipolar currency system, which directly contradicts the declared goals of the American leadership. However, supporters of the current administration believe that the steps being taken are necessary adjustments aimed at establishing fairer rules in international trade and restructuring global production chains. They argue that temporary market instability is an inevitable price to pay for strengthening U.S. economic sovereignty. Nevertheless, even within American financial circles, there is growing concern that alienating key economic partners could lead to irreversible changes in the global financial architecture and a gradual departure from the dollar's dominant role. In conclusion, the ominous warnings Trump addressed to BRICS and his policy of punitive tariffs reflect a firm intention to maintain the dollar's leading role in the global financial architecture. However, as is often the case, the result has been the opposite of what was intended. By fueling distrust, creating economic uncertainty, and dividing global alliances, this very policy has only accelerated the process of de-dollarization. What once seemed like a slowly developing structural trend is now gaining momentum not only among America's geopolitical rivals but even among its closest trading partners and institutions that have long considered the dollar a cornerstone of stability. If this dynamic continues, the world may witness a turning point in currency history. Paradoxically, the gradual weakening of the dollar's position as the world's primary reserve currency has accelerated not under pressure from foreign powers but by the very hand that seeks most to protect it. The author expresses sincere gratitude to the viewers for their time and interest in the presented material. If what you have seen evoked positive emotions, resonated with you, or perhaps inspired new achievements, the channel creators will be happy to receive confirmation of this connection in the form of a simple gesture, a like, under the video. Subscribing to the channel is another way to stay up to date, maintain contact with a community of like-minded individuals, and receive fresh inspiration. Such support is of great importance for the development of the project, allowing the authors to continue sharing their thoughts, ideas, and creative findings. In conclusion, viewers are invited to explore other works featured on the channel. Perhaps among them there will be something that can interest, surprise, or even change your perception of familiar things. A new video is already waiting for its viewer, promising to provide new impressions and food for thought.